So let us assume that in year 2000, if you invested 1 lakh rupees, right? That 1 lakh rupees by 2021, end of 2021, would have become 11 lakh 64. In 2008, Warren Buffett placed a $1 million bet to say that index funds will outperform hedge funds. And guess what? In 2018, he won that bet. Also, he said that when he's gone, when he's dead, 90% of his estate investments will be invested in index funds. In this video, I'm going to break down in a very simple way what index funds are, how to go about picking the right index fund if you are interested, and lastly, I will do a live investment on one of my favorite index funds, so stick around till the end. Let's go. So the first question is, what is an index? So let us take an example of National Stock Exchange, NSE. On NSE, more than 1600 companies are listed. On any given day, you ask me, Rahul, how's NSE market doing? I can't tell you that, right? Because there are 1600 companies. Some of the company share prices would have gone up. Some of the company share prices would have gone down on a particular day. I can't tell you how the market is doing. That is why indexes were created, okay? So for National Stock Exchange, one of the key index that we look at is Nifty. Now this Nifty, what it does is basically it looks at top 50 companies listed on National Stock Exchange and tells you the movement of those top 50 companies. These top 50 companies are selected from different sectors. So right now, if you look at it, there are 13 sectors. So for example, finance, IT, oil and gas. So various companies from different sectors are selected. How these companies are selected? They are selected based on their market capitalization, free float market capitalization. Again, I'm not going into the details of how the Nifty is calculated, but ultimately looking at the market capitalization of these top 50 companies, Nifty, a number is calculated. So right now that number is roughly 16,300 plus. On any given day, if this number shoots from 16,000 to let's say 17,000, we say the market is doing really well, right? If the number drops down to let's say 15,000, we say that market is not doing well. So this index tells us, it's a measurement and it tells us how the market is performing. Likewise for BSE, we have got Sensex. I hope this very basic concept is very clear to you that index is basically telling you the movement of the stock market. Now let us learn about index funds. Let us now understand the core concept of index funds. Okay, let us take an example of UTI. So for example, UTI has set up a Nifty fund. Okay, and let us say you, me, and so many other investors start to put the money into this fund. Okay, so 10,000 here, 20,000 here, 30,000 here, and so on. Let us say 1,000 crore is what the total funds have got into it. UTI would have set up a fund manager who will manage this fund, right? What this fund manager will do is he will basically look at Nifty50 Index, right? And as now we know that in Nifty50, we will have top 50 companies in their market capitalization proportion. So his job is to go ahead and invest this 1,000 rupees into these top 50 companies in the exactly same proportion as Nifty50 Index, right? Because he is now investing in this index, right? Now, what will happen is these companies, they will periodically change this proportion. So their job will be to make sure, let's say if the Reliance from 11% goes to 12%, what they will have to do is go and buy more Reliance stocks to make it 12%. And let us say if TCS from 9% goes to 8%, right? What this index fund manager will do is go ahead and sell some of the TCS stocks to bring it to 8%. So they make sure that they are exactly tracking this Nifty50 index, right? Now, few important points I want you to understand here. Number one, the difference of this index fund with the small case is that here, as an investor, you are not directly having ownership of these stocks. You own the portion of this fund, but you never own the stocks, which is the case in small case, right? So this index fund is like, it is a mutual fund. The big difference between mutual fund and the index fund is that in mutual fund, this fund manager is actively going and picking variety of stocks depending on what that mutual fund is and investing the money into the active stocks. While in case of index funds, what happens is they are simply following a index. That is why they are called index fund. And the biggest advantage of doing that is that the expense ratio of the index fund is very, very low as compared to a mutual fund, right? So the expense ratio that I will show you, for example, for the UTI index fund is very low, roughly 0.2 to 0.3%, depending on what we are looking at. But this is one of the reasons Warren Buffett placed that bet and said that he prefers index funds because of their low expense ratio, low expense, basically the low cost to buy these funds as compared to mutual funds, right? So these are the key differences, and I hope the core concept of this is clear. This is why it is called passive investing, because you're actively not going and investing into and picking the stocks. This is why the term of passive investing is referred for index funds, right? I hope the concept is now very clear. Let us now move to the next segment of this video. Now you may have a question to me, Rahul, what about the returns and risks? Now let me show you, break down the returns of Nifty 50 Index and risks associated with it. Let's go. Let us now have a look at the returns Nifty 50 Index has given in last 20 years so that we understand the return and the risk associated with it, right? Have a look at this. 2000 minus 14%, 2001 minus 16%. Look at 2003, 71%. Look at 2008. We know the reason for this, minus 51%, right? So every year Nifty Index has given high rewards, but some years they have given very, very bad returns, right? So the key message that I want to deliver here is that it is not for short term. Don't try to time it. You will see even within a particular year, for example, let's take it this year here, right? 2009, this January month minus return, February minus, March started to pick up and really gave good returns, right? But the situation for, and this is not a pattern by the way, Jan, Feb, March, it might look completely different in some other year. So in 2015, for example, January we got 6%, February we got 1%. We cannot we cannot try and time the market when it comes to stocks. Again, there are huge risks here, huge rewards there, as is the case in stock market. But what I've done is I've come and solidified one key principle that I want to show you with some numbers and some research, which is if you are ready to invest in at least for 5 years, you are not going to lose money. Let me show it to you with numbers now. So what I've done is I've taken those Nifty 50 returns I just showed you on the screen and have talked about 5-year investment. Okay, so let us assume that in year 2000, if you invested 1 lakh rupees, right? That 1 lakh rupees by 2021, end of 2021, would have become 11 lakh 64 if you invested that 1 lakh. And just to put this in context, if you invested that in fixed deposit for a 7% interest rate, you would have got 4 lakh 14,000 only, right? So this is the return you will get after 20 years. Let us now look at if you invested in 2005, 1 lakh rupees rather than in 2000 rupees, that 1 lakh rupee would have given you at the end of 2021 would have given you 6 lakh rupees return. Okay, so here is the 6 lakh rupee. If you did that in FD, you would have got only 2 lakh 95,000 rupees. Likewise, if you invested this 1 lakh rupees in 2010, looking at the returns that Nifty 50 has given, you would have got 2 lakh 81,000 only. And in FD, you would have got 2 lakh 10,000 rupees. Likewise, if you did it in 2015, you would have got 2 lakh 16,000, but in FD, you would have only got 1 lakh 50,000 rupees. What does it tell you? It tells you, number one, don't try to time the market. Look for long-term investment when it comes to index funds. They definitely are valuable. I have proven it by this data that in Nifty 50, if you invested for 5 years block, you are likely to get more returns than a fixed deposit. And that is what the numbers tell me, right? So why I am very bullish about index fund? Another reason is that in the last 2 years in India, index funds growth have touched the roof now, right? So if we look at the numbers, have a look at this chart here. 2020 in India, we only had 32 index funds. In 2022, it has gone up to 78. And the number of, and the AUM, the investment amount has gone up roughly 600%. So everybody's going crazy on index funds. Now let us move to next segment of this video and talk about how do we go about picking the index fund. Let's go. Let us now understand how do we go about selecting the right index fund. There are 3 parameters. Number 1 is expense ratio. Very, very important. What is expense ratio? Very simply, if let us say you invest 100 rupees in an index fund, 1% is the expense ratio. It means 1 rupee out of that 100 goes towards managing that fund and managing the various fees associated with that fund, right? Lower the expense ratio is, better it is. okay, for us. But we will talk about how do we go about selecting the funds. Number 2 is the tracking error. What do I mean by tracking error is how closely an index fund is able to track the index itself. That is called tracking error. And if it is lower, it is better, because then it is very closely tracking that index fund. Generally what happens is, where these errors come in, let us say some particular stock has given a dividend. Let's say Reliance has given a dividend, right? Now that needs to be reinvested back into the fund, right? And if you leave it too late to go back and reinvest that money, then you're not able to get that uplift that you might have got otherwise, right? So these are the nuances where the tracking error comes into picture. So lower the tracking rate, better it is. Number 3 is the AUM, which is the assets under management. Bigger the pool of the assets are, better it is, because then you get scale of economies, right? So these are the 3 parameters. Now let's have a look at this chart. What you see on my screen here is the different index funds, their expense ratios, their tracking errors, and the AUM, right? We are interested in the Nifty50 Index, for example. So let us just look at the Nifty50 Index for a minute and let us see what is going on here. So let us look at the SBI here, 0.17, very good. HDFC 0.20 in terms of expense ratio. So UTI is 0.20 here, as well as DSP here is 0.21, 0.3. So let us not talk about these because their expense ratio is very high. ICIC 0.17 and 0.16, right? Likewise, look at the tracking error here. So they are very similar here as well. This is higher tracking error, so we are not going to go for them. Again, these are having higher tracking error. We are not going to go ahead with them, right? This leaves us these 3 here, right? And look at these, they're very similar. In terms of asset under management, if I look at that, UTI index is far better than these 2. But again, let us not make that decision in silos. One other important factor I want to talk about is the real expense ratio. What you see stated here is 0.20, but do you think this is the actual real expense ratio? Absolutely not. Let me now show you a gold mine. Let us have a look at this chart here, and what you will see is this chart shows the last 1 year from 2021, 1st of April 2021 to today, what is the actual returns, and therefore what is the lowest expense ratio that we need to look at. Okay, so if you see on top here 0.10%, right, no index fund has given us that much of return. But if you look at this here, UTI Nifty, for example, if I only talk about Nifty50 indexes, they are the more stable ones, and they are the ones who has given the lowest expense ratio, which is 0.33%. Now, mind you, this is higher than what they stated. So the stated expense ratio for UTI was 0.20%, but it is never the case that they will deliver to what is stated, right? But look at the IDFC Nifty here, 0.93%, right? And look at the fluctuation they've had in the returns, right? So if it is less stable, you should not invest in it. Likewise, UTI here is very stable line. So they have been managing this fund really better and getting very close to the Nifty50 returns, and therefore their expense ratio is really low as compared to others. And this is one thing that not many people will know. In the market right now, for example, Navi's expense ratio has been talked about. They're claiming it to be the lowest one, but the actual returns are very different. So please make sure you do this research to understand what are the actual returns these index funds have given you over a period of time, and then accordingly pick yours. In this example, I am very confident and clear that UTI Nifty Index has given us far better return and has given us consistency here across the few months. Therefore, for me, it is a UTI Nifty50 Index that I'm now going to invest in front of you live. Let's go. Let us go ahead and make the live investment on the UTI Nifty Index fund right now. So let us go to my Zerodha account and I say buy, and I am going to add 25,000 rupees in there investment amount and just say buy now. Confirm, and boom, I have got invested now 25,000 rupees in front of you in the UTI Nifty Index fund, because I genuinely believe that this is a better fund as compared to others. It's not a promotional video. I'm not doing any promotion whatsoever, but I hope you saw the value of doing this analysis and making sure we do some research before we go and invest any money. By all means, this is not an advice to you. This is not an investment advice at all to you. It's mainly to show you how I have gone ahead and done the investment based on my analysis. To conclude, if you ever want to invest in index fund, please think long term. at least 5 years. Number 2, look at the real expense ratios to make sure you're getting good value, good return out of your money. And number 3, all the index funds, especially the stock ones, they are not risk-free. So make sure you do your analysis, do your due diligence, and do not delay investing. If you have never started investing in index funds, start them today. I hope you like the video. Please give it a thumbs up, subscribe to this YouTube channel, because that's how I will bring powerful content to you around career and finance. If any specific topic you want me to make videos on, please drop them in comments. Any questions around Nifty 50 Index, please drop them in comments. I'll be happy to answer as much as I can. Until then, signing off. Have a good day.